I'm Charlotte McLeod with investingnews.com, and here today with me is Tavi Costa, partner and portfolio manager at Crescent Capital. Thank you so much for joining me. Great to see you.
Thanks for having me.
Great. So we're here at the New Orleans Investment Conference, and one thing that I wanted to start by asking you is about sentiment among the juniors. I know that you talk to a lot of these companies. There's some here out on the show floor, although I don't think you've probably had time to go out there yet. But yeah, just your thoughts on sentiment, because I know there's a lot of negativity right now, and I wondered your thoughts.
Well, sentiment is despite the fact that valuations are quite similar than where they are a year ago, I would say the big difference in not only sentiment, but what's happening in this environment is we're starting to see the engagement of major companies with the smaller businesses. Some of them, even gold companies, now approaching electrification metal projects, types of, copper and cobalt and other things that didn't used to be in their agenda, but now currently are becoming part of their agenda. And so it's sort of interesting how that has been shifting. Certainly the access for capital remains very, very difficult for companies to raise money in this environment. So you're seeing some of the balance sheets that stay strong are starting to do very well. But there's a difference between two types of companies. There's sort of some of those that are being very disciplined, which is the right approach. And there are other ones that are hunkering down significantly, which is not the right approach. And they basically disappeared, just given the fact that the market is not very favorable. I don't think that's the right thing to do in this environment. You should continue to be advancing a project and doing things to unlock value of your company over time. But so there's definitely a few different pockets of how companies are behaving. And the sentiment remains, to me, just weird. It just seems like everyone is sort of waiting for this breakout in gold. Otherwise, there's no party, right? Everyone is just waiting patiently. And in my view, it's going to happen. It's inevitable that we're going to see a breakout, and then other commodities should follow, and the valuation of companies should be re-rated. So.
Okay. A couple of points to pick up on there. I think it's funny. I asked Rick Rule this morning the question, is it ever a good idea for companies to do that hunkering down kind of strategy? And he said the same thing. He said, no, you should keep moving forward. So that's pretty interesting. Other point I wanted to follow up on with you. Okay, so you said you're seeing companies that are in things like gold and maybe copper shifting into other things like battery metals, lithium, that kind of thing. When I see that happening, I generally think that doesn't look good. Like maybe you should stay in your lane, focus on what you know best. What do you think? What does that mean to you?
Oh, I would probably agree with you. And the reason for that, actually, if you look back in history, the production of gold itself, right now we're seeing production of gold declining for many reasons across the major companies. Some of that has to do with the quality of the projects, quality of grades, and all those things have been causing them to be more constrained to increase production over time. But if you look back all the way to the 70s and see when or other times we saw this type of reduction of production, of top line growth in those businesses, is, it usually coincides with the gold cycle. It's interesting that companies kind of lose their focus at the very wrong time. And in my view, this is the exact time that you want to be actually deploying capital into gold projects. I love electrification metals. I think this agenda for green revolution and other things is probably going to be driving things a lot higher. But more importantly, there is indeed a global debasement happening across many fiat currencies. And I think one of the most important kind of institutional pitches that most companies should be using is the fact, how do we go from having a reshoring of economies, developed economies in particular, revamping manufacturing capabilities, how we're going to go from, the green revolution itself, revamping even electrical grids, increasing defense spending without making the mining industry a lot more relevant than what it is currently. And that to me is just, when we see this inflows of capital that I think it's kind of inevitable as well, along with gold prices breaking out, it's gonna re-rate everything. So you want to be really focused right now on those projects. I'm not gonna be very selective on, if it should be gold or copper. If a project is high quality and it deserves the capital to be deployed, we're gonna be looking at it. So That's sort of our approach right now.
Okay. And you've mentioned kind of a couple of times we're waiting for this breakout in gold, or it seems like a lot of people are. And I think people who follow you on Twitter will know you post a lot of interesting charts there. And one of the recent ones was looking at triple top in gold and the breakout potential there. So I wanted to ask you about that chart and why that is such a bullish formation.
Well, it's a bullish formation because technically speaking, and by the way, technicals don't matter, right? There is other things that are much more important than this. But to answer your question, there's something called a double top. A double top, you should be very careful. Usually when that happens, which is what's happening right now with FANG stocks, the Magnificent Seven, and some other issues. When you look at those businesses, yes, that type of technical formation is very bearish. Now, a triple top usually is something that it falls. It does mark a top initially, but then what you see is a true recharging moment of the asset price, and then you see a much higher breakout that tends to be what drives the beginning of a long-term cycle. So to me, gold is in a classic technical setup for that. Now, the macro is even more interesting because the U.S. and other developed economies are facing, in my opinion, something very unique. It's sort of a chronic debt crisis with embedded inflationary forces. And the U.S. economy, and not just the U.S., but other developed economies too, they're completely heavily reliant on fiscal stimulus at a time when we already have government debt at levels that we've never seen unless you're talking about war periods. And so I don't know how we're going to, really balance all those things without making hard assets a much more relevant portion of the economy. And then you look at 60-40 portfolios, or those what they call the traditional investment strategies, and they don't allocate any capital to hard assets. So how do we, how can we even come up with a bearish view on those things? And what are hard assets? Those are commodities, gold, and so if you're driving, let's say, if you're managing a portfolio, a very kind of traditional portfolio, and now you hold 40% of bonds and so forth, you're in a kind of a pickle. You want to own some of gold as a defensive alternative. Same thing for central banks. Central banks enhancing the quality of their international reserves. And so you're starting to see some shifts happening already. It's creating shifts in correlations too in markets. And I think this is just the beginning. I think we're going to see a lot more. So, I'm super excited because I think this is a generational wealth kind of opportunity right in front of us.
Yeah, and I like that you separate out the technicals from what's going on in the macro, because I know that they can be important, but some people would favor one over the other. But it looks like for gold, they're both kind of moving in the same correct direction.
Yeah, it's, from a technical, already kind of said a little bit about it, but even from a macro side, taking away just the fact that if you look back in other gold cycles, I would say the 70s, we had a kind of an inflationary time. We broke the gold standard, so that drove gold prices higher. We saw some accumulation of gold by central banks. In the early 2000s, we had the second cycle in gold, and that was really driven by China entering the WTO, becoming a manufacturing plant of the global economy. They drove commodity prices higher, then gold prices went a lot higher too. But we didn't see central banks buying gold at that time, which is really interesting. And today, we kind of have both environments happening. All G7 economies have to reshore and really revamp, like I said, their capabilities, industrial side, on manufacturing side, even on the public side in terms of airports and highways and all sorts of things. All that requires materials. And then on top of it, I think what we're seeing today is quite inflationary compared to other periods. And if you look at the forces, deglobalization is a large one, reckless fiscal spending, the chronic underinvestments in natural resource companies, all those things, the affordability of housing. How do you fix that issue? You're going to have to build more. So inequality problems. What happens with inequality issues? Well, you tend to see more social programs. So all those things are kind of playing a role into creating a much more inflationary era that eventually drives investors back to precious metals and tangible assets overall.
Okay, I think my question now would be, how important is timing for you? Because when people hear about things like, okay, the gold breakout is coming, they always want to know when. But Is that so important, or is it more important to be positioned for when it does eventually happen?
Don't remember who said this, but do you know what the difference is of what is the definition of a long-term investment? Have you heard of that before? It's a short-term investment that didn't work. So, all of us want our investments to work in the next day, and unfortunately, that's not how it works. But back in 2018, just to be very clear, I started really looking at the CapEx trends of natural resource companies, and you can kind of see when that bottoms out, you tend to see a bull market in commodities. And this is, you just don't know on the macro side what the trigger is going to be, but the foundation of the thesis is there. And it's the same with oil, it's the same with agricultural commodities, with gold, with silver. And people get too hung up. Oh, gold is up, it's about to make new highs, but silver is not moving, it's not leading the way. I don't think this is a real movement. Just don't get too hung up on those things. I mean, this is the time you want to be focusing on assets that are high quality, that actually have exposure to silver, or things that will probably lead the way to the upside as you see a gold cycle. So it's, I wish I had a better answer for you, but I feel like everything is really coming together right now, and the sentiment is really bearish, even among most of the people that are speaking in this conference. I mean, if you talk to them off camera, they're not very bullish right now. And I'm not going to name names, but, I am not that way at all. I'm extremely bullish. I'm really focused right now because I do think this is the time to be, like I said, you don't want to lose focus at the wrong time. And I think the majors are doing that. And, I don't think money managers should do the same. So.
Okay. So you're very bullish. We talked about gold and kind of a little bit of your focus there. Where else are you seeing these opportunities in the resource sector? I know we've talked about this before, but if we could get your updated thoughts.
Well, I think gold is not the only thing. Certainly silver, copper, cobalt, manganese. Zinc is an important one for us. We recently acquired one of the largest silver and zinc mines in the world, the St. Cristobal mine in Bolivia. That to me is one of the best vehicles to kind of make money in this market of higher prices. It's important to know that when you identify that you are in an inflationary area, what do you do as an investor? Well, you want to be buying companies that have pricing power. And which ones are those companies? It's a really hard analysis to make. And in my opinion, commodity businesses have an inherent pricing power in their business model, which has to do with the underlying price of commodities. When they rise, they obviously have the tendency of charging more for their source of their products. And so it's sort of normal to see commodity businesses doing well during inflationary periods. I think that's the most important thing, is to look for those types of kind of macro forces that potentially are creating this kind of long-term cycle of that. And if that's the case, then you want to be deploying capital into commodities. And I think you can take a diversified basket approach. It happens to be the case that I believe that, look, the metals and mining industry, even relative to the energy companies or energy sector, are just a fraction of that, right? So to me, like I said, I don't know how we're going to go through all those fiscal sides of the agenda right now without making the metals and mining industry a lot more relevant. And so to me, taking kind of a niche approach into mining is very attractive. And so that's why I've been very focused on that. But I think there's going to be people that will make a lot of money on agricultural commodities and, perhaps in energy as well, and all sorts of things. And even, some people like to do that in housing market. Well, housing market is another tangible asset, but I don't think it's as asymmetric, but, some people will make money with that, I'm sure.
Okay, and I want to go back to a point that I think you made earlier. You brought up the 60-40 traditional portfolio and how that is kind of on its way out. So what do you see that being replaced by? What do you think people are going to go more toward?
Well, that's a very good question, because if you looked at 60-40 portfolios as kind of the aggregate valuation of those, so if you take the valuation of the equity markets, give a 60% weight, and take the bond market, give it a 40% weight, aggregate that all the way to the 1800s, you're going to see that right now we're one of the most overvalued periods in history. And you may say, well, but the bond market already fell apart, and maybe there is more opportunities there and so forth. But in aggregate, they're still very expensive. And the problem is one feeds the other. So if rates start moving higher, then you have to discount companies' present value of businesses lower. And so those two allocations need to be redefined. And so to your question, I think commodities are going to play a role there. I think gold is going to kind of be one of those assets that are going to be more of a competing with treasuries, just like central banks have been, changing their allocation. I mean, back in the 70s, they used to own 80% of gold relative to treasuries. Now it's the opposite. So can we see, just going back to historical average, maybe 50% of central banks' assets is in gold? That would be a huge change. And so, or there was a research recently on how much gold advisors own today in their portfolios. 70% of them said that they own less than 1%. So, I mean, how much do you have to lose in here? So to me, that's the type of kind of risk-reward opportunity that I enjoy kind of looking for. And so I think that's going to be one side, gold, and then a basket of commodities will probably take the other side. And I would say emerging markets, especially rich resource economies like Brazil, will probably take a part of the equity market portion. So that's going to be a very interesting way of allocating, capital over time. And so I'm also really, really interested in that market.
Okay, as we're starting to wrap up, I have a question. I think it's a fun question. I've been asking this one to all or most people. If you had to choose an asset to hold for 5 years, you want to get the best return, doesn't have to be in commodities, but of course it could be. What would you choose?
I think would be silver. But I also think, I think it would be silver. That would be my answer. But I also think there are mining companies that would do very well, but you're probably asking more of an asset class question. Yeah. I would also answer that Brazilian equities could do very well. I think that they have a very good chance of having a good run. And potentially natural gas from now until 5 years. I think we're going to have, the problem is it wouldn't be something I would hold today until 5 years, because that, natural gas is very volatile. But I do think you're going to see a big spike in the next 5 years in that gas. And it's a very volatile and explosive commodity like silver. I think silver will be more of an established kind of movement. But sorry, I gave you 3 answers, but those are kind of the things that come to my mind.
That's great. 3 for the price of 1. Okay, as we're finishing up, any final thoughts that you would leave investors with kind of as we head toward the end of the year?
Well, I think this is an interesting setting in terms of the investing environment, because of where interest rates are right now. There's a lot of things that haven't been repriced according to where the cost of debt really is. And we're going to see a lot of refinancing of sovereign institutions and corporations and even households. And the reason why we haven't seen things really break yet is because most of the effective interest rate is still very low relative to where actual interest rate really is. And effective interest rate is just looking at the total debt and seeing how much people are paying for interest payments and relative to that. So we're going to see the refinancing of those instruments moving forward. If people are not going to go into the debt market and issue more debt at a higher interest rate, what are they going to do? They're going to dilute their equity. So we got to think about this as a risk in terms of the financial markets overall. And I think there's some pockets of volatilities that are really cheap right now. Credit spreads is one of them. I think mega cap stocks offer good opportunities for hedging. I think the volatility in terms of the FX market is going to be quite attractive. I mean, I think we're back to the old days of macro when, George Soros used to make a bunch of money on shorting currencies, or we've had a Druckenmiller and some other guys who made their names basically shorting and looking for kind of volatility events in the FX market. So I think all those things are going to be, coming back to this environment in the next 3 years, you said.
Okay, I think that's a great place to wrap it up. Thank you so much for coming on to share all this with investors. I think this is really valuable.
Thank you.
Thanks. And once again, I'm Charlotte McLeod with investingnews.com, and this is Tavi Costa. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.